So, Bruce, we had a little twist in the story yesterday with the Pfizer news, which the market took extraordinarily well. I'm curious if it changed anything about your timeline or base case for this pandemic.
Hi, Bonnie, and great news for Pfizer, and it's going to be a long winter for sure. Caseloads we're hearing about in Italy, but around the globe here in the United States, soaring, hospitals filling up, and so I think the most relevant, kind of conclusion I come is remain very vigilant and don't let your guard down. The markets, though, give us better definition as to timing, and so healthcare sector is back in favor again, and credit's heating up. So we like this trend. We like what we see, and there's lots to do.
Yeah, it's interesting though, Bruce, because the credit markets in a lot of ways look a little bit like they did in February. So when the Fed stepped in, it sort of rained on the parade just a little bit. What are you anticipating now in terms of things like default rates, the probability for fallen angels and so on?
Well, liquidity crisis is, stopped dead in its tracks when the Fed came in with $4 trillion of QE in a matter of 5 weeks. Remember back in 2008 and 2009, it took 5 years for QE1, QE2, QE3 to put $4 trillion of liquidity in the system. And so the high yield index as we sit here right now today is the lowest on record ever, right? At 4.75%. And issuance, meanwhile, because of the ability of companies to issue, is a record year of issuance. We've already seen over 400 billion of issuance. And so what's really interesting about this dynamic is that coming into COVID, 50%, actually less than 50% of all high yield had double B ratings. And today, because the high yield issuers with the better ratings are issuing, today it's 56% are double B issuers. And remember, back in 2008 and 2009, only 40% of high yield issuers were of double B rating. So what we're seeing right now is we're seeing a tale of two cities, Bonnie. We're seeing balance sheet leverage, which is huge, by one cohort. And so you look at the leverage loan index and debt to EBITDA ratios are in excess of 6.5%. And so it truly is a K-shaped recovery. We believe, significant restructurings on the horizon. And so when you look out this next year or two, default rates will probably stay elevated, I think around 6% in 2021 and 2022. And amend and pretend will be back in vogue in a big way. Right now, today, there's 100 companies in the U.S. who have missed, middle market companies, who have missed interest payments, and active negotiations are going on right now. So Marathon, in fact, has a proposal out with the company. It's being documented right now with their lawyers, where we're finalizing new money solution to keep the company out of bankruptcy. Very low coupon, but a big, huge above market pick. So we earn a lot of interest on the accrued basis, and we're taking a good chunk of the equity from the sponsor to also tie that to the debt financing that we're providing. So the bottom line on all this, Bonnie, is I think 2020, there'll be $200 billion of defaults in the high yield market, and 2021 and 2022, with default rates at, say, 6%, at least $100 billion each these next couple of years. So we're finding compelling opportunities. Security selection is key, of course. And I think you want to ride this horse, the credit horse. It has legs, and it has legs for both what's performing and what needs new money solutions. But you need to be very vigilant and stay away from companies and industries that are in structural decline.